People are struggling to pay their student loans, mortgage defaults are rising, and there's a record number of people delinquent on their car payments. All in all, people are defaulting on their debts, and this spells trouble for the economy. In this video, I'll explain why this is happening and what you can do to make sure that you're protected and strategically position yourself to even make some money. Let's break this down. Okay, so here's what's happening. Number one, student loans are restarting. There's no more free rides. 5 million people are currently in default, which is a number that could easily reach 10 million, as some borrowers will face difficulty paying back these loans. Number two, mortgage delinquencies now match 2008 levels, which led to the Great Recession. And number three, car loan defaults hit record highs with people paying $700 a month for rapidly depreciating assets. It isn't bad luck. It's systemic debt squeeze, and like lined up dominoes, they will fall. Economists call this a negative feedback loop, where less spending leads to a weaker economy, which leads to layoffs, which leads to even less spending, which leads to defaults rising, which leads to lenders tightening credit, which leads to less money flowing through the economy, which leads to prices dropping. So here's the critical question. Where do you stand when the dominoes fall? Because in moments like these, fortunes aren't just lost, they're also made. By the end of this video, you'll know the hidden pressure points in the crisis, and it's not what the media is fixated on. And number two, where smart money is moving to thrive and not just survive the challenges ahead. It's always about adapting and pivoting. Okay, so let's talk about student loans and the payment pause ending. So when COVID hit, the government paused the repayment of government-backed student loans, and this gave borrowers a break from paying loans while dealing with COVID and its fallout. Well, that temporary 5-year pause, it's now over. During the 5-year holiday, some people may have forgotten that these loans existed and reallocated their budgets towards other things, like their mortgage, a car loan, or even babysitting services, for example. With the hiatus now over, people are forced to rethink their budgets once again. But here's the thing. Before the government put a 5-year pause on collecting the debt, millions of borrowers stopped paying their student loans and they were defaulting. By instituting the pause, the government saved millions of people from involuntary collections like wage garnishments. And instead, the government made it so that people could use those freed up funds on spending towards other things, not student loan related, and keep the economy moving, even if it was in that fake economy kind of way. So starting this month, when a borrower doesn't pay their student loan, the government will be reaching into their paychecks and taking the money, as much as 15% of it. So think of it this way. If you make $100,000 a year, the government could take $15,000 of your salary. So that means $15,000 less to spend on other things. Well, if millions of people have to redirect their money towards their student loans, that means they won't be able to spend it on other priorities. And that's how economies shrink and crisis begins. Okay, so now let's talk about the housing market and the rising delinquencies. So this one's a little more complicated to explain, so bear with me as I try to break this one down for you guys. So the government wants to encourage homeownership. It's good for the economy and it's good for communities. But the government knows that getting your first home can be a little difficult, so they give you a boost. And the way they give you that boost is by lowering the standards it takes to qualify for a government-backed home loan. Now, it's not an ideal loan because it often ends up costing the borrower more over time when you actually account for the higher interest rate and the mortgage insurance premium. But it does allow for an otherwise risky borrower to get into a home. But this has its consequences. Last year, 7% of federally backed mortgages went unpaid for 90 days or more. And if 7% doesn't sound like much, just know that 7% is about the same level as 2008 when the Great Recession happened. So over the course of the last 5 years, the federal government has taken action to prevent a crisis and keep the economy afloat. Their approach was not too different from their handling of student loans. Here, they essentially gave borrowers behind on their mortgage payments a payment holiday. And basically, the federal government would make a payment to the lender on the borrower's behalf. But that same amount would be added to the borrower's principal loan amount, which means that in the long run, the borrower would have less and less equity in their home, and maybe be even underwater. It's not ideal for taxpayers, and it's definitely not ideal for the person behind all their mortgage payments. The only winners here were the lenders and the banks that happily dished out risky loans, knowing that the taxpayers would be on the hook for defaults. But those days of payment holidays might be over because the funds reserved for those programs haven't been replenished. What hasn't changed, however, are the number of defaults, and that number could rise further given inflationary pressures. And maybe there's now a student loan to pay on top of everything else too. Okay, so now let's talk about auto loans and defaults reaching new highs. So another sign of financial stress is defaulting car loans. Americans have been falling behind on their car payments more than ever before. With an average new car price of about $50,000 and an average monthly payment of $700, it's not hard to see why some people might be falling behind. And to worsen matters, many people are opting for longer loan periods, as much as 7 years, to try to keep their monthly payments lower. But a longer loan period means paying more interest on the car, which creates a situation where someone could owe thousands more on a car than it's actually worth. And the situation is only expected to get worse as people buy cars ahead of when they normally would have to avoid the tariffs. We're stuck in an untenable situation where you're damned if you do buy that new car now and you're damned if you don't. And side note, did you guys know that there's cars made in China called BYD and they sell for as low as $10,000? So if they were made available in the USA, then this might help a lot of people be in less debt. Just saying. In the meantime, the car loan will take a number behind the new but old student loan debt, piling mortgage payments, and everything else. So have I painted the picture for you guys? And what do you do with this information? Less money flowing through the economy translates to less purchasing, which is what leads to recessions. If what I'm anticipating proves true, I'll become bearish in my strategies and look to make profit by shorting or entering put positions. Okay, so what do we do? How do we survive? And better yet, how do you make some money? Because this information is real, if not scary. As a new investor and as an American, I prefer to make my money in an economy that's going up. And though I hope this is the case, I need to prepare my thinking for what might come. So I'm going to be watching the economic indicators to confirm that the economy is indeed weakening. And I'll also begin monitoring companies in both auto sales and auto loans, and student loan servicing and mortgage lending. There's so many companies to choose from, so I'll be focusing on the ones that are most affected by defaults. So for example, companies that are most likely to be affected by defaulting mortgages are traditional powerhouses like Bank of America or Wells Fargo, because they deal a lot in mortgage lending. I would also concentrate on banks like Rocket Companies or United Wholesale Mortgage, because they specialize in mortgage lending. For student loans, I'll focus on Sallie Mae, Navient, Nelnet, and SoFi. And they're all in the business of servicing student loans. Lastly, for car loans, I'm watching Carvana, which is an online used car company, and they actually did really well during these trade wars because people are buying more used cars as a cheaper alternative to expensive tariffed new cars. Also, just so you know, Carvana trades just below $300, and in December 2022, it traded as low as $4.05. So you might ask, how did that happen? Well, in 2022, COVID supply chain issues caused higher inflation, and as a result, cars got more expensive and people had to take out bigger loans and they defaulted on those loans. This was very hurtful to Carvana because in addition to selling cars, they were also financing them. So as you can see, the stock tanked as both the sales and the financing division suffered. Seems like we're in a situation where history might repeat itself, and if what I'm anticipating proves true, again, I'll become bearish in my strategies and look to make profit by shorting or entering put positions. For those who are patient, I would suggest waiting until the market has found its bottom. And here's an example to illustrate my point. So in March 2009, Bank of America traded at $3.14. But in 2006, it got as high as $53.87. So just imagine, if you were aware enough to know and patient enough to wait and confident enough to buy Bank of America when it was $3.14, a stock that trades above $44 today and pays a dividend, where would you be today? In closing, I remind myself that I might not know the future, but I know what's happening to position myself in preparation for tomorrow's unknown. Okay, so if you enjoyed this video, please be sure to like, comment, share, and subscribe, and turn on your bell notification so that you get notified every time I upload a brand new video. I will see you guys next week, and have a wonderful week. Bye!